All right, let's look at the labor variances here in exercises 9-9 and 9-10. Exercise 9-9 will look at the direct labor rate variance, and then in 9-10 we'll look at the quantity variance. They're both based off of the same question stems here. So standard labor cost per unit of $45, which is made up of standard labor per unit of 3 hours at a rate of $15 per hour. The company incurred actual direct labor costs of $4,300 when it produced 100 units of finished product this month. It took them 275 hours to produce all 100 units. Based on this information, we're going to calculate the labor rate variance and the labor quantity variance. So I've reproduced the information from the question here. We wanted to calculate for our formulas, we want to know what the actual rate per hour is. How I would calculate that, I take the number of hours that they actually incurred, which was based off the question, or the costs incurred, which was $4,300, and I'm going to divide that by the actual hours worked, which was 275, and you can see that in the formula there. So that gets me an actual rate of $15.64 approximately per hour. The standard hourly rate, which is the estimates done at the beginning of the year, is $15 per hour. So you can already see we're going to have an unfavorable labor rate variance because we spent more per hour than anticipated, but we'll get to that in a minute. Actual hours worked was 275, which they told us. The standard hour per unit, so this is the amount of time they expect to spend on each unit, is 3 hours a piece. They actually produced 100 units during the period. The last variable we have to calculate is the standard hours. This is like standard quantity when it comes to direct material. This is the amount of hours we would have expected to work based off of actual production. So we actually produced 100 units. If each unit does in fact take 3 hours to produce, which is our estimate, our standard hour per unit, then we should have only spent 300 hours to produce all 100 units. And again, you can see the formula there, multiplying the standard hour per unit times the units produced. Well, we actually spent 275, so we actually used less than anticipated. So we'll talk about that in a second. So let's look at each of the variances. We'll start with the direct labor rate variance. The direct labor rate variance, remember, that's the difference between what we actually paid per hour versus what we expected to pay per hour. And we'll multiply that by the actual hours worked. So in this case, we actually spent $15.64 per hour when we anticipated we were going to only pay $15 per hour. So we paid 64 cents more per hour. We multiply that difference, that 64 cents, by 275 hours that were actually worked. We get a labor rate variance, and you can see the formula there, of $175, and that is going to be considered an unfavorable variance. The reason it's unfavorable, again, we spent 64 cents more per hour than anticipated. So that increased our labor cost by $175. Now getting to the quantity variance. The quantity variance is the difference between the actual hours worked, which is 275 hours, and the standard hours worked, which we calculated was 300 hours. So we actually used less hours than anticipated. So we saved time, and therefore we saved money. We saved 25 hours, and the assumption is that each of those hours costs $15 per hour. So we multiply the 25 by the 15. You can see the formula there. We get a labor or quantity variance of $375, and that should be marked as a favorable variance because we used less than anticipated. So we saved hours, therefore we saved money when it comes to direct labor. In this case, we saved 25 hours, and if each hour saves us $15 per hour, we save $375